Hello and happy Thursday, everyone. It is Scott Wohlers with River Place Capital. It is Thursday, May the 29th. I want to take just a brief minute to discuss what markets did last week, as it is very not surprising to have a week of digestion after a 5% plus week the previous week. So we did see markets down last week, with the S&P 500 being down 2.61%. The mid caps were down a little worse, and of course they're going to be a little more volatile. They were down 3.58%. And the small caps, again, going to be the least liquid, going to be down the most, down 3.9% on the week. And that's not surprising, again, seeing such a momentous run higher off of the lows that we saw in April. And again, as we sit here on May the 29th, we've come full circle and we've had a lot of headlines that have driven the market down and up. And I'll pose this question to you. We've done a whole lot for what? Nothing has really fundamentally changed in the United States economy. Nothing politically or policy-wise has been enacted or really changed. We have a delay in the tariffs. We had the announcement of the policy of the potential tariffs, which you saw a dramatic rundown in the market. It's going to cause a draconian recession. It's going to cause all of that. And oftentimes when you see volatility in the equity markets, the financial press is really good about bringing out people who will talk about all the things that could potentially go wrong in the market. While those are very valid and very true, there are also things that could go right and keep the momentum in the market going higher into new highs and keep the economy moving forward. So I wanted to take just a moment this week to talk about some of those positives that again may move this market higher instead of having a bias to the downside. Not saying we're not going to deal with volatility from here on out, but let's talk about some of the things that could go right in the market. So tariffs, if you look back to the first administration and the first administration's time with that, you did see tariffs enacted, but you did not see an increase in inflation. Tariffs may bring in additional revenue to offset government debt and the deficit that we have. Don't forget about all the spending and all of the AI that is happening. AI is going to be introduced more and more in the corporate world, and we're finding more and more productivity out of AI and how to apply that to work functions to make things more productive. Productivity is a drag or brings down inflation, does not increase inflation. It helps increase corporate earnings, and that allows the market to move higher. You also have all of the money being spent in the government. Even with this, deficit spending is stimulative. All the money being spent on AI is stimulative to the economy. You also have potentially the onshoring of more jobs over time, which could be a benefit to the U.S. from the taxes generated from it, from the workflow. The other thing is we have not seen cracks yet in employment. And while the American worker is still working and getting a decent wage, the economy will continue to move forward. We're a consumption-based economy. Until the drain plug is pulled or the spigot gets turned off of the employment numbers and you start to see cracks there, this economy can move forward. And the environment is ripe for that. We're going to see some deregulation. We're going to see some M&A activity. We're going to see things that are historically beneficial for economic business growth. And so that's not a political statement, that's just history says that these types of policies provide economic growth. And so as we look at and we look ahead for the remainder of this year, and it's unbelievable that we're almost halfway through the year, but as we're looking out for the second half of 25, we do see these things as catalysts to move the market forward. And we wanted to offer a contrarian point of view with all the negativity out there, that there are some positives going on. The economy did contract Q1 by 0.2%. That was because a lot of inventory was ordered ahead of the tariff announcement. Had you had inventories historically normal, you would have seen a 2% growth rate. It's what the Atlanta Fed is forecasting for this quarter is a 2% growth rate. That's a very healthy growth rate for the United States economy. The soft data was showing signs of slowdown, but the hard economic data is not showing that at the time. So why shouldn't we continue to move forward is the question that I'll pose to you. So if you have questions about how to navigate this time or how we're getting to the conclusions we are, we'd love the opportunity to tell you about it and talk to you about it. You can reach us at 904-346-3460, or as always, check us out online at www.riverplacecapital.com. I hope everyone has a wonderful rest of your week. Thanks so much for watching.